The US dollar index is on the brink. After shedding over 12% since its 2025 peak, it now sits just above 100, a psychological support that has held for decades. This week could be the moment it cracks wide open. On Friday, the Bureau of Labor Statistics releases the July non-farm payrolls, the most important jobs report of the summer. But that is only part of the story. The Federal Reserve's latest meeting exposed a deep hawkish split, and the Bank of Japan's suspected intervention over the weekend has rammed the dollar lower. In the next few minutes, I will walk you through exactly what happened, what data matters, and where the dollar, the euro, and gold could go. If you have exposure to Forex or commodity markets, you cannot afford to look away. On Wednesday, the 29th of July, the Federal Open Market Committee kept interest rates on hold at 5.25 to 5.5%. But the vote was far from unanimous. At least 2 voting members dissented, arguing that the robust labor market and stickier-than-expected core inflation made the case for higher rates, not lower ones. This hawkish split wrong-footed traders who had priced in a clear dovish pivot. Markets now realize that the Fed's reaction function is much more uncertain than assumed, a point MUFG analysts stressed in a note on the 30th of July. If this week's jobs data shows the economy is still running hot, the hawks will gain the upper hand, potentially pushing rate cuts well into the second half of 2027. That uncertainty is exactly why this week's data calendar is so explosive. The week kicks off on Monday with the ISM Manufacturing PMI, where the employment subindex will be the first clue. On Tuesday, the 4th of August, JOLTS job openings for June land at 3 p.m. London time, with the consensus around 7.6 million. Wednesday brings the ADP private payrolls estimate for July, forecast at 185,000. Thursday we get the weekly initial jobless claims and the ISM services report. But the main event is Friday's non-farm payrolls at 1:30 p.m., where economists expect headline job growth of about 195,000, an unemployment rate of 3.6%, and average hourly earnings rising 0.3% month-on-month. Anything north of 200,000 on NFP and wage growth above 0.4% would seriously test the dovish narrative. The dollar index's struggle near 100 is no accident. Over the weekend, the Japanese yen surged sharply, prompting traders to suspect Tokyo had intervened to support the yen, as reported by TMGM on the 1st of August. That intervention hammered the dollar across the board. DXY now hovers at 100.05, with clear support at 99.5. A daily close below that level would be a structural break, opening the door to the 97 handle. On the flip side, resistance sits at 101.5, where the 50-day moving average converges. MUFG warned that the Fed's clouded reaction function makes the dollar's outlook especially fragile. This week's data will either validate the dollar's downside or give it a sharp reprieve. The euro is mirroring the dollar's weakness. Scotiabank's note from the 31st of July sees the range for euro to US dollar around the mid-1.15s, and right now we are trading at roughly 1.1530. If US labor data disappoints, a move towards 1.1650 is very realistic. In commodities, gold has tumbled from the lofty $4,000 level, with TMGM reporting on the 23rd of July that sellers are targeting $4,000 as resistance turned support. Gold now sits near $3,880. Meanwhile, oil prices have edged lower, easing inflation risks, a development OCBC highlighted on the 27th of July as a positive for risk sentiment. A cooling labor market could reignite gold's rally, while strong jobs numbers would extend its correction. The Federal Reserve has made it crystal clear that every future meeting is data-dependent. If Friday's NFP prints above 200,000 with average hourly earnings ticking up, the hawks who dissented on the 29th will appear prescient. Rate cut bets would evaporate, the 2-year Treasury yield would spike, and the dollar would surge. Conversely, a print below 150,000, or a rise in the unemployment rate to 3.8%, would bring September rate cuts firmly back onto the table, perhaps as much as 50 basis points. The MUFG analysis correctly points out that the sheer range of possible outcomes makes the dollar's path this week a coin flip until the data lands. Traders need to watch the bond market and Fed funds futures for real-time repricing. Let us map out the two most probable scenarios. Scenario 1, the dollar bull case, a strong NFP above 200,000, upbeat ISMs, and JOLTS holding steady. In this case, DXY rips towards 101.50, euro to US dollar drops to 1.1450, and gold slides towards 3,750. Scenario 2, the dollar breakdown, weak jobs data, job openings falling below 7 million, and a jump in jobless claims. Then DXY slices through 99.50, euro to US dollar charges to 1.1650, and gold reclaims the $4,000 mark. The most realistic outcome may sit somewhere in the middle, but the market is not positioned for a middle ground. It is primed for a breakout. The message for the week starting Monday the 3rd of August is simple: the US labor market will determine the near-term fate of the dollar. Watch the 100 level on DXY like a hawk. If the jobs reports confirm a cooling economy, the hawkish Fed split becomes noise and the dollar could slide sharply. If the data stays resilient, the hawks may win the argument, forcing a painful repricing of rate cut expectations. Stay nimble, respect your stop losses, and keep an eye on Japanese intervention headlines. I will be back each day this week with live analysis as the numbers hit. If you found this forecast helpful, subscribe and turn on alerts. The week ahead promises fireworks, and you will want to be prepared.